Hey, welcome to this video on leading indicators examples. And however, there's no such thing as an indicator that always leads the market. So you have to put it in the context of an entire trading method, just like you do with everything. There's no one indicator that's going to be the crystal ball as to what's going to happen in the next 5 minutes or 5 months in the market. That's not how it works. We use it as one piece of evidence. So one of my most popular videos that I've done is on the SMI indicator, Stochastic Momentum Index. And we've got that down here. So I thought, okay, I'll use that one today. Because in traditional technical analysis, momentum indicators are generally accepted as leading indicators. And I like to add the word potential to that because most of the time they don't lead to the market. And so you have to understand what type of patterns do, when they do, and so forth. So, first of all, let's look at something very interesting that a lot of people don't understand. First of all, that's not an indicator. Okay? Stochastic is not an indicator. SMI is not an indicator. CCI, when we just plot it here, in other words, that's really not the indicator. Let's look at what the indicator really is. Okay, now that's the indicator. All right. So it might be semantics, but my point in showing you this is, and this is just part of the formula, and this is the SMI, the Stochastic Momentum Index, but indicators are mathematical formulas. So let's just get real clear on that, first of all, that that's what they are. That's all they are, but that's okay. So it is true that they do not always tell the future. Well, you know what? Let's put it this way. What indicators do? They indicate. The answer is actually in the question. They indicate. Indicators are not money makers. There's no one indicator in the world that will directly and by itself make you money. If they did, we wouldn't call them indicators. We'd call them money makers. All right? So they indicate something based on math, and that math is, well, here's one example, but what it's taking is it's taking data from whatever market you're trading relative to whatever time interval you're trading, and it's putting it in one side of the formula, crunching it based on the formula, and then spitting a number out the other end. So what that means is an indicator actually is never wrong. Indicators are correct 100% of the time because math isn't wrong. It's just what is. And so one of the reasons that I do like to use a couple of indicators, I just use 2 indicators, I don't get crazy with it, is that it gives me an objective number to work with, a value of the energy of money flow that is going through that market. And it's always right because it's based on math. It is math. It's not based on math, it is math. And so therefore, it allows me to create an objective, rule-based system based on a mathematical formula, actually a combination. This is just one. Okay, so let's go back to the chart now. So we've got our SMI here, Stochastic Momentum Index. Remember, momentum is one of the most commonly accepted leading indicators. And we've got the market going down, 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 down. All right, now at this place you will see what is commonly referred to as a divergence. So we have a lower low on price, higher low on the Stochastic Momentum Index. So now what does that really mean? What's behind that? We've all heard of divergences, or at least most of us who've been around for a while. And so a divergence is nothing new, but a divergence by itself, frankly, they don't always work. So again, this is what I mean by sometimes in certain situations, these indicators can give you leading ideas. Now here's what this is. So first of all, what momentum means is the market's going down and it's going down on strength. So think of a train going down the tracks, and let's say that train is going 90 miles, or well, let's say it's going 60 miles an hour, and it's got 30 cars behind it. So it's got velocity and mass. That is the equation for momentum, right? Just the basic physics of it in the real world. So it's in the same way, in the market, when you've got the market moving with velocity and mass, it's more likely to follow through. So back to our train example, if you were to apply the brakes to a train that was going 60 miles an hour and had 30 cars behind it, the train's not going to stop right away. there's a leading indication of just the pure physics of momentum. After you apply the brakes, that train is still going to continue to go north a mile after you apply the brakes, because that's the physics of momentum. So in a similar way in the market, when the market is moving with a lot of velocity, a lot of mass equates to volume, then we could say, okay, it'll probably sustain. And when the brakes are applied, then it's going to start slowing down. Now, where is the brake is applied? So here is our signal that we've had a momentum shift. So price does make a lower low. In other words, the train is still going, in this case, south, but the brakes were applied back here, and it maps it for us. And that's one of the nice things about indicators, is that they just map that money flow dynamic on a chart, so it's actually very easy to see. Now, you could do the same kind of thing if you're a tape reader, but that actually requires quite a bit of skill and experience. So this is a shortcut. Now, that's not all. Sound like the guy on TV, but that's not all. And it's not, because what we want to do is we also want to say, okay, how extended are we in this trend? So we all know the saying, the trend is your friend until the end, right? So if you get a momentum shift like this early in a new trend, it's probably not going to really mean much. You might get like a little ABC complex retrace and then continue down in the direction of the trend. So the longer you wait, we've got a failed to 9 wave count here, and a 5 in the way that count waves is average. So anytime we get beyond 5, now we are saying, oh, okay, statistically, this is a trend that has lasted longer than is normal. And so now we wait for strength to come out of that downtrend to help us determine when the trend will end. So this is the signal, boom, and it ends. Now, something very, very, very important. Muy importante. Where does the market go? Kind of goes sideways for a while. So the learning moment here is that just because momentum did come out of the market, and sure, we did stop trending, we did not get below the low of that bar, that does not mean the market's then going to go screaming up. So a downtrend is not always followed by an uptrend, and an uptrend is not always followed by a downtrend. Trends can end, in fact, I would say trends more frequently end by just going sideways for a while and not reversing. This is why trend reversal trades are so tricky. They do have the best reward to risk ratio when they work, but they don't actually work that often. So the win-loss ratio is low. Yes, I wanted to give you one more example because I showed you how to determine the end of a trend. Well, how do you get in early to a new trend? Because that is a more common way, a better win-loss ratio. So here we've had market, just kind of basically, not doing too much here. And even in here, right, still kind of going sideways. But look at momentum. What is momentum doing? From here to here, it's still about the same. And then it goes crazy. It goes way above that level. So in other words, again, momentum, in this case the SMI, is breaking above this level here on the indicator before price really makes significantly higher highs. Price is still just going sideways. So what's happening is accumulation. So in TopDogTrading, we like to take the first cycle low in a new uptrend, which is wave 2 right there. And we can do that inside of price consolidation, knowing that, oh, the momentum has already come in. And then we get our wave 3, we get a wave 4, we get a failed 5, then we get a wave 5, but now here it is again. How do we know to get out there? Well, momentum now has come out of the market. So price made a higher high, but the indicator made a lower high. There's your common divergence. And again, that's just saying, okay, we moved up, but on weakness, the brakes on the train have been applied. So therefore, it's just a matter of time before we do start coming to an end. So if you like this video, if you got value from it, please understand that, sure, it's free, but you do have a moral obligation to pay it forward by clicking the share button below. And also, love it if you give me a thumbs up and leave a comment. Love your comments. They really encourage me to create more tutorials. Also, I'm giving away one of my favorite trade strategies called the rubber band trade. It has a very, very high win-loss ratio. I'm going to give it to you absolutely free in a 26-minute video. And this gives you everything, all the rules on how to do the rubber band trade. All you have to do is click on the image in the top right corner of this video, or also in the description below the video, there's a link where you can access it. And if you're not watching this on YouTube, then there's probably a link either above or below this video or an opt-in form on the side. Once you do that, I will personally email the video to you with the rubber band trade strategy.